You're about to see breaking market commentary that will change the way you think about this bull cycle. Because while everyone is celebrating the 3-year anniversary of the bull market, the real story is what comes next. And the signals are far more dramatic than most investors realize. Today you'll hear why Wall Street believes we're not even close to the peak, and also the exact risks that could shatter that pattern. Stay with me. This is one of the most important interviews of the year.
You note the bull market just hit its 3-year anniversary, and historically, you say, that is a positive milestone. So let's start there. I'll double barrel this one.
Sure.
One, just walk me through that. Explain that. Why is that a positive milestone? And two, I guess, Kevin, if I'm an investor, I hear that and I wonder, okay, so what are though some big risks that could maybe break that pattern?
Yeah, anytime I see a significant milestone like that reached in the market, Josh, I turn to my research team in New Jersey and I say, is this a good sign that better days are possibly ahead? Or is this a sign that the best days were behind us? In this case, it appears as though it was the former, as they were able to go back 50 years and actually see that there's been 5 previous times when a bull market has reached its 3-year anniversary. And in all 5 times, it continued to move higher by an average total duration of 8 years, which would suggest we got 5 more years to go. The shortest duration was 5 years, which would suggest we have 2 more years to go. And in 2 cases, we hit double digits in terms of total years of that bull market run. Now, of course, this time could be different. Past performance isn't indicative of future results. We know all of that. But there does seem to be multiple tailwinds that would support the markets moving higher. But I still contend that the areas of the market that led the first 3 years may very well not be the areas that lead the next 3 years.
Can I ask you, in terms of risks though, all right, history suggests positive milestones.
Yes.
What would be on Kevin's wall of worry there?
I think there's multiple walls of worry, and I don't subscribe to the AI bubble is about to burst camp. In fact, I think those investors who are fearful of an imminent bursting of the AI bubble, that fear is either misplaced, premature, or potentially even both. And if you're waiting for that bubble to burst, you're likely to miss out on the most significant returns that the AI revolution may have to offer. But the risks to me are, what does the Federal Reserve do or not do with respect to interest rates? Ultimately, what happens with US-China trade policy, and of course, valuations. Valuations remain stretched right now, and the money keeps going into the areas of the market that are the most stretched in terms of valuations. So I look beyond that. I look to areas like industrials, utilities, maybe some communication services name as well, because they're all part of the AI revolution, and they're not as stretched in some places in terms of valuations as some of the semiconductors and chip plays.
On AI, Kevin, I know you're in the camp that says, okay, this looks to you like early innings.
Yes.
Another strategist said, forget early innings, we're not even at the plate yet.
Batting practice, that's me.
Okay, let me ask you though, to that point though, my friend, as an investor, what are the signals that you looked at that tell you this is early, not peaking?
Sure. So what I look to is Jensen Huang, the godfather of AI, the CEO of NVIDIA. What he told us is that he believes there'll be somewhere between $3 to $4 trillion with the T spent on AI infrastructure investment by the end of this decade. So if we're at about 700 billion right now, to get to 3 to 4 trillion in the next 4 years, that's a lot of spending that's coming down the road. And where's that spending going to go? In the batting practice, the infrastructure build, the data centers, the power solutions, the cooling solutions. Not necessarily the AI algorithms and the hardware and the software plays. That's going to come when we start playing the games. And that ROI, Josh, won't be reached for years to come. So investors are going to have to be patient on that front and try and identify more winners than losers in building a diversified portfolio. But for now, the infrastructure play continues.
What you just heard is a powerful reminder. History supports longer bull runs, but markets never move in a straight line. And here's the key takeaway. This isn't just a tech rally anymore. The next leg of the bull market may shift into areas most investors are ignoring: utilities, industrials, power infrastructure, nuclear expansion, AI data center development, and aerospace. This aligns with the biggest structural theme of the decade: follow the capital expenditure. When trillions flow into AI infrastructure, data centers, cooling systems, energy supply, and defense, that's where long-term investors need to pay attention. But the risks are real too. Fed uncertainty, US-China tensions, and stretched valuations could create sharp volatility. Any Fed surprise could trigger a knee-jerk sell-off. But historically, those dips have been bought aggressively in early-stage bull cycles,
In some of those big tech AI plays, Kevin, we were talking off camera about this. Some of the divergences are really interesting. If you look in, for example, the past month, Alphabet's a rocket ship.
Yes.
But Meta's been whacked.
Yep.
Oracle's been whacked. And I'm wondering if that tells you what it tells you. Do you think that tells you, indicates to you, okay, investors are starting to draw harder lines here?
Absolutely. I think investors are trying to pick the winners now. And what they need to realize is that the AI revolution is going to be a very long road filled with many potholes. And like previous industrial revolutions, there'll be more losers than there will be winners. I think the losers, though, will be defined as those who either overspend or underspend. And the circular financing that's taking place within the world of technology right now truly is a survival of the fittest because they don't want to be left behind. But the best way to ride this AI revolution, I believe, is to make investments all across the AI ecosystem, including, as I said earlier, the data centers. How about the utility companies that are supplying the power to these data centers? The nuclear evolution that we're seeing, whether through small modular reactors or nuclear power plants. Build them all into your portfolio, incorporating power solutions and the AI ecosystem, and I think you'll find they have a higher likelihood of finding the winners and avoiding some of those losers.
This is the Cryptagon. Stay sharp, stay informed.